It's that time again. Bulls and bears both think the other side is stupid. Whether your position doubles this week or gets blown up on a spot may come down entirely to the next few trading days because this week 7 central banks are set to announce their rate decisions. US GDP and PCE data are also coming in hot one after another. And right at the center of the storm is the Fed's FOMC meeting, which may be ready to pour a bucket of cold water on this overheated market. Whether you're trading gold, US equities, or crude oil, you need to stay extremely sharp this week. Let's start with gold. Gold is in a very awkward position right now. Azerbaijan sold 22 tons of gold just a few days ago. And remember, it was been one of the major buyers in the global gold market. Selling at this point means they are not optimistic about the short-term outlook. They are choosing to cash out at elevated levels. This suggests the current level is probably not a real button of the gold correction. On top of that, this Thursday's FOMC meeting could be a make or break moment for gold. No cut decision is basically locked in for this meeting. The real battleground now is this. Will the Fed respond to the inflation rebound caused by surging oil prices by sending an extremely hawkish signal? If the Fed really comes out hawkish, gold will likely face a deep pullback because under the high interest rates, the opportunity cost of holding gold will crush its appeal. And on the flip side, any dovish pivot or signs of weaker economic data could give gold some breathing room. So my view on gold right now is very clear. Before the US and Iran actually sit down and sign a meaningful agreement, or before global central banks clearly signal a return to the rate cut path, gold will likely stay in a choppy and weakening structure where every bullish catalyst turns into a sell the news event. Short-term rebound, I would treat as a bull trap. Now let's talk about US stocks. Can US stocks keep going higher? That's the question everyone is asking. 80 straight gains, fresh all-time highs, and that is exactly when things becomes the most dangerous. There's an old Wall Street saying, markets are born and disappear, rise on top and die in euphoria. And right now, sentiment is getting dangerously close to euphoria. The famous big short investor, Michael Burry, has already made his move. He publicly disclosed that he bought put options on Nvidia, the Nasdaq 100, and the Philadelphia Semiconductor Index. But pay attention, these puts expire in January 2027. They are not short-term bearish bets. In this field, the market has heavily priced in the narrative of massive data center expansion and chip shortages. If those expectations reverse in the future, stock prices could see a meaningful correction. But we need to separate a correction from a crash. The fundamentals of semiconductors are not broken. So if the upcoming earnings from the mega cap names fail to meet expectations, it may trigger a sharp technical correction, not a full cyclical collapse. And lastly, let's come back to crude oil. Its playbook is the simplest and almost the most dangerous. If the ceasefire agreement gets extended indefinitely, the market's fear of an oil supply cutoff will fade quickly. But that does not mean oil prices will definitely fall. It means pricing power is slowly moving away from Wall Street traders and back to fundamentals. In other words, real purchase orders in the physical market. Right now, Brent crude has held firmly above the USD 100 level for several days, and this is not being driven by panic anymore. It's been driven by real supply tightness. Global crude inventories are currently sitting near historically low levels, and as the northern hemisphere gradually enters peak oil demand season, the supply gap could become even more obvious. Keep a close eye on the supply-demand structure in a physical market. Once the bullish logic shifts back to fundamentals are really driven by real shortages, usually has stronger momentum and lasts much longer. To sum it up, gold depends on the tone of the major central banks. US stocks are testing the patience of the big short crowd, and crude oil is pricing power is returning to fundamentals. As always, this is just my personal trade analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content.